Today, we're going to talk about what trading is. The concept of trading is becoming increasingly popular and is appearing in the media and on social networks. Yet it remains unknown to many people. In this video, we'll delve into what trading is all about. The basic principle of trading is buying and selling assets in financial markets to make a profit. These assets can include stocks, currencies, commodities, or cryptocurrencies. Essentially, it's an exchange of products for money. Let's illustrate the purpose of this activity with an example. Meet Pedrito, who decides to enter the market with a capital of $10,000. He buys 2 shares of Tesla when a single share is worth only $50. He makes this purchase with the expectation that these shares will rise in the long term. Over time, Pedrito's prediction comes true, and the value of these shares increases from $50 to $500. Here, Pedrito decides to close his purchase, essentially buying low and selling high. Similarly, Pedrito can benefit from falling prices. For example, if Tesla's shares are initially worth $100, and Pedrito decides to place a sell order, profiting when these shares drop to $50. In this way, we can benefit from the price decline by taking the difference. Knowing this, entering the markets involves 2 actions: placing buy orders and sell orders on an asset. Before buying or selling, it's mandatory to define the lot size. What is lot size? Let's use the example of Carlos. I tell Carlos that for every meter he walks, I'll give him $10. If he walks a total of 10 meters, I have to give him the equivalent of $100. Similarly, in trading, before executing a trade, we must define the lot size, essentially telling the asset's price that for every point it moves, it will be equivalent to a certain amount of money, whether in favor or against. For example, if we place a buy order on the euro-dollar and set a lot size of 5, we are telling the price that for every point it moves, it should give us $5. This means that regardless of the direction the price takes, it will either add or subtract $5 from our capital. Now let's talk about a super useful tool when trading: the stop loss. The stop loss is a tool that sets the maximum loss the investor is willing to assume in a market operation. For example, let's assume we have a capital of $1,000, and we place a buy order on the euro-dollar, deciding to risk $100. We set the stop loss at -100. If the price moves against us and touches the stop loss, the operation will automatically close, deducting the $100 from our capital. The goal of the stop loss is to prevent incurring larger losses. Now let's discuss take profit. As the name suggests, it means taking profits, which is the opposite of the stop loss. Basically, take profit is a level at which we want our operations to close automatically to lock in our gains. For example, if we buy a share of Amazon at $100 and want to sell it when it rises to $300, we simply set the take profit at $300, and when it reaches that price, the take profit will automatically close the gains. If we want to trade in the markets, we can't do it on our own. Instead, we need an intermediary called a broker. When we make a trade, it goes from the broker to the market. What a trader seeks in the markets is nothing more and nothing less than profitability. Let's explain this in a straightforward way. Profitability is having a positive result from your capital over a certain period. This can be measured annually or monthly. Let's look at the following example with Pedrito. In January, Pedrito achieves a 10% increase in his capital when he closes the purchase of the shares. In other words, his $10,000 in capital increased by 10%, which is $1,000. Then, in February, Pedrito closes his capital with a positive 6%. And in March, he achieves a 3% increase. In this example, we can see something very evident. Month after month, Pedrito has been profitable, no matter how small the percentage. In trading, this is the meaning of success: profitability. Now let's talk about what they don't tell you about trading. The reality is that trading is not as easy as it's portrayed on social networks and the internet in general. If we had to define trading, it would be the most challenging way to make easy money. It's said that 95% of people who trade end up losing money. The reality is that there is no precise percentage of profitable traders, as it varies depending on the information source. However, some studies suggest that only a small percentage of people become profitable. This information can also be verified with brokers and funding companies that show statistics of people losing money and those withdrawing money from the market. The percentage of people losing money will always be higher than the minority of profitable traders. A question we must ask is, why do most people not become profitable? Many factors influence this, such as a lack of knowledge, lack of emotional or psychological management, and a lack of risk control, among others. The simple fact of having to speculate on the price of an asset makes a challenging task. In fact, there's a quote from an analyst named Ferran Caiofre that says, "The most challenging profession on the planet is trading. I have no doubt whatsoever." The reality is that it's possible to make a living from trading, but it requires a long-term commitment, dedication, and extensive study. In conclusion, don't be deceived by promises of overnight success with trading. That's it for this video. If you liked it, leave a like, subscribe, and let us know in the comments what topic you'd like us to cover in the next video. So, leave your like, subscribe, and we'll see you next time.